Have you ever had that feeling that the story you're being told just doesn't quite add up? For years, the official narrative about silver has been pretty straightforward. It's an industrial metal, there's plenty of it, and its price is stable. It's a story designed to be reassuring. But what if the actions of the biggest players in the game tell a completely different story? Welcome to the Bullion Signal Podcast, the channel where we look past the headlines to understand the macro financial landscape, protect our assets, and decode the signals hidden in plain sight. Today, we're diving deep into one of the most significant, yet least talked about events in recent market history. It involves one of the world's most powerful banks and a move so quiet, so subtle, that most of the world missed it entirely. But this move, as we're about to see, speaks volumes. This is the number that changes everything. 13.4 million ounces of silver. Now, this wasn't some dramatic Hollywood heist with armor trucks and alarms. This was something far more potent. A move made with the stroke of a keyboard that effectively made a mountain of physical silver vanish from the market. And that's the billion-dollar question, isn't it? Where did it go? The answer pulls back the curtain on the fragile mechanics of the entire precious metals market. It's not just a story about silver. It's a story about the fundamental conflict between paper promises and physical reality, and what happens when the people who wrote the rules start preparing for their own game to end. So let's be perfectly clear about what we mean by vanished. The silver bars themselves weren't vaporized. They most likely didn't even move from the shelf they were sitting on inside a Comex vault. But through a simple, perfectly legal accounting change, they were removed from the world's available deliverable supply. And that, my friends, has implications that are frankly staggering. To really get our heads around this, you have to understand a fundamental and frankly bizarre feature of the precious metals world. There aren't just one, but two distinct markets for silver, operating in parallel. They are deeply interconnected, yet they operate on completely different principles. And the tension between these two markets is where all the drama and all the opportunity for manipulation lies. On one side, you have the paper market. This is the digital world of futures contracts, options, and ETFs. It's where the price you see on your screen every day is born. It's a place of immense leverage where hundreds, and I mean hundreds, of paper claims can exist for every single ounce of actual physical silver in the vaults. Think of it as a casino. Then you have the physical market. This is the world of real metal, hard assets, coins you can hold, bars you can stack. This world isn't governed by algorithms. It's governed by the laws of physics. It's finite. You can't print more of it. The paper market may set the price, but it's the physical market that holds the ultimate truth. Now, when you have this kind of setup, a classic playbook emerges for those with enough capital to run it. It's a two-step dance. Step one, you use your immense resources to flood the paper market with sell orders and futures contracts. This creates a tsunami of artificial supply, which has the very real effect of pushing the spot price down. Step two, once the price is artificially suppressed, you quietly step into the physical market and buy up the real thing, the actual metal at a discount you yourself helped to create. It's a brilliant, if cynical, strategy. And before you dismiss this as some wild conspiracy theory, let me show you this number. $920 million. That's the size of the fine that JP paid in 2020 to settle charges for a years-long scheme of, you guessed it, manipulating the precious metals and treasury markets. This isn't speculation. This is a documented, admitted-to fact, a cost of doing business. This history is absolutely crucial. We have to view their more recent actions through this lens, because when an institution has a documented history of rigging prices using paper contracts, it establishes both motive and method. It sets the stage for what comes next. A maneuver that is far more sophisticated, perfectly legal, and perhaps even more telling about their long-term view of the market. The key to their latest move, the mechanism that made those 13.4 million ounces vanish, lies within the plumbing of the Comex exchange itself. It's a kind of shell game, and it all hinges on two very boring-sounding accounting categories. But trust me, the difference between these two terms is the difference between a promise and a reality. First, we have registered silver. Now listen closely because this is the only pile that truly backs the entire system. Registered silver is the specific metal in the vaults that is officially earmarked and available for delivery to someone who wants to cash in a futures contract for the real thing. It is the public-facing supply. It's the only metal that guarantees the entire paper market isn't just a fantasy. And then there's eligible silver. Now these are identical silver bars, often sitting on the very same shelf as the registered bars. But there is one critical, all-important difference. Eligible silver is privately owned. It is not for sale. It is completely unavailable for delivery against a futures contract. It's there, it gets counted in the total vault numbers, creating the illusion of a massive supply. But if there's a run on the exchange, that metal might as well be on Mars. Here's the best analogy I've ever heard for this, and it makes it perfectly clear. Think of a bank. The registered silver is like the cash in the bank's main vault. It belongs to the bank and is available to meet customer withdrawals. The eligible silver is like the contents of a private safety deposit box located in that same bank building. It's physically there, which makes the building look full of assets, but the bank has absolutely no right to open that box and use what's inside to pay its depositors. The shell game is getting everyone to look at the total in the building, not just the cash in the vault. So once you understand this critical distinction, the public vault versus the private box, what JP Morgan did becomes shockingly clear. It wasn't a complex trade. It was a simple administrative reclassification of their own holdings, a move that was unprecedented in its scale. Let's look at the situation before the move. This chart represents the entire global stockpile of registered, deliverable silver. This is the bedrock, the foundation of trust for the entire market. As you can see, JP Morgan held a very significant slice of that public promise. Their metal was part of the pool backing the system. And then this happened. With a single filing, JP Morgan reclassified 13.4 million ounces of its silver. They moved it from the public registered category into their own private eligible category. The pie itself shrinks before your eyes. The very foundation of available, deliverable metal for the entire world market got visibly smaller in an instant. Again, the physical bars probably never moved. All it took was a keyboard stroke. But that simple action was the equivalent of taking a massive pile of cash out of the bank's main vault and locking it away in their own private safety deposit box. For all intents and purposes, that silver had just vanished from the market. To really feel the impact of this, you have to look at the raw numbers. Before this event, the total amount of registered silver across all Comex vaults worldwide was just over 150 million ounces. That's it. That's the entire backstop. This chart puts it in stark visual terms. The first bar is the entire global supply. That second smaller bar is the chunk that JP Morgan just took off the table for themselves. And what did that move represent? It was a reduction of 8.9%. Think about that. One bank with one move on one single day single-handedly removed almost 9% of the planet's entire exchange-ready silver supply. I'm going to say that one more time because it is that important. In a single 24-hour period, nearly 1/10 of the world's liquid available silver supply was taken off the market. This wasn't some minor shuffling of inventory. This was a tectonic shift, a strategic withdrawal of historic proportions. And this, of course, brings us to the ultimate question. Why? Why would one of the market's most dominant players, a bank that has profited immensely from the paper game, suddenly make a move that makes the already tight physical supply even tighter? Well, the timing tells us everything we need to know. This move didn't happen in a quiet, stable market. It happened right at the peak of the silver squeeze movement, a period when retail investors were putting unprecedented pressure on the paper markets, demanding physical delivery. The system was showing signs of real strain, with reports of bizarre, multi-hour trading halts on the exchange. Now, let's just think logically here. If you are a major bank and you're worried about a crisis of confidence, a run on the bank, what do? You do everything you can to project strength. You would move silver into the registered category to reassure the market that you have plenty of metal to meet demand. JP Morgan did the exact polar opposite. This is not the action of an entity trying to calm the market. This is the action of an entity battening down the hatches, securing its own physical supply ahead of a storm they see coming. And that leads to a conclusion that is both simple and deeply unsettling. This move was a signal, a powerful one. When the very architects of the paper system, the financial giants who benefit most from the status quo, start quietly taking their own real physical chips off the table, it means they are preparing for a day when the game itself might change or end altogether. They are protecting their own wealth for a time when paper promises are no longer enough. So I'll leave you with this final thought. It's one thing when people on the outside criticize a financial system. That happens every day. But it is an entirely different matter when the ultimate insiders, the rule makers themselves, start behaving as if they don't fully trust the stability of their own creation. When the players who run the casino start quietly cashing in their own chips and heading for the exit, what does that signal to the rest of us about the state of the game? That's our analysis for today. The key takeaway is this: the actions of the big players often speak louder than their words. This move by JP Morgan is a clear signal that physical metal is viewed as the ultimate safe haven, even by those who profit most from the paper system. If you found this breakdown valuable, please consider liking this, sharing it with someone who needs to hear it, and subscribing to Bullion Signal Podcast for more deep dives into the signals that truly matter. We're here to help you navigate the complexities of the market and protect your wealth for the long term. Disclaimer. Please remember, the content provided here is for informational and educational purposes only. It is not intended to be and should not be construed as financial, investment, or legal advice. You should always conduct your own research and consult with a qualified professional before making any financial decisions. Your financial future is yours responsibility.